In this video, let's explore what is accounts receivable. Accounts receivable is a debt from customers for goods sold on credit. When goods are sold to customer gets ownership to the goods. However, payment for these goods will be received later. After some time, customer will pay to the seller for the purchased goods. Debt from customer will be covered. When goods are sold to customer, but payment is not yet received, seller will account for accounts receivable in its accounting records. The following accounting entry is done. Debit, accounts receivable. Credit, sales revenue. Accounts receivable is an asset of the seller, which represents right to claim debt from customer. After some time, customer will pay for the purchased goods. The following accounting entry will be recorded in the accounting records of the seller. Debit, cash. Credit, accounts receivable. In certain cases, based on the agreement with the customer, sellers can provide discounts if payment is received earlier. In such way, sellers encourage faster payment for the goods sold. Such discounts are called discounts for early payments. For example, if the seller sets the following conditions for the payment: 2/10 and N/30. This means that general payment terms for the customer is 30 days, which is marked N/30. 2 is discount percentage, and 10 is the discount period. This means that if payment is done within 10 days, customer will give 2% discount on the amount of payment. For example, let's assume that the sale on credit amount was $1,000. With the following payment conditions, 2/8 N/30. The following accounting entry is done at the time of the sale. Debit, accounts receivable, $1,000. Credit, sales, $1,000. Such entry indicates that the business has an accounts receivable of $1,000 from the customer, to whom goods were sold. If the payment is received in 8 days, seller will provide to the customer 2% discount on the amount of payment.
In case of earlier payment, the following entry is done. Debit, cash, $980, which is the initial amount of sale, decreased by 2% discount. Debit, sales discounts, which is 2% of the initial sales amount, $20. Credit, accounts receivable, $1,000, which is the initial amount of sales. 2% discount on early payment, amounting to $20, decreases amount of payment. Less cash is received. In case the payment by the customer is done within standard payment period, which is 30 days, customer gets no discount. The following accounting entry is done. Debit, cash, $1,000, full sales amount. Credit, accounts receivable, $1,000, full sales amount.
Thank you for watching. Do not miss our new videos. Make sure you subscribe to our YouTube channel right now. Just click subscribe button below this video.
Let us know what kind of videos you like more. Practical problems, or theory explanation. Please leave your comment below the video. Thank you for your comment.